Good afternoon and welcome back to the KPMG Africa Conversation series. I'm Alicia Sekum, and in conversation with me this afternoon is Junior Ngulube, who's Chief Executive Officer of Munich Re of Africa, BC Lamnikara, who's Head of Management Consulting at KPMG Nigeria, Nicholas Young, Chief Operations Officer for Africa at Citibank, and Dave Cook, who's Director at Actis as well. Junior, let's pick up where we left off ahead of the break. I mean, in emerging markets, in developing markets, with the young financial services sector, initially it's the smaller balance sheets that are hard to leverage off, not only in terms of chasing opportunity in targeting the consumer market, but also in catering to major financial investments, whether it be in the infrastructure space or the the power space, etc. Step in insurance and a reinsurance player like yourself to bolster these balance sheets, right?
Yeah, exactly. I think it basically talks to the developmental nature of reinsurance, in that we support insurance companies to grow their own balance sheets, while in the initial stages writing some of the business onto our balance sheet. That's what we basically do as reinsurers. And in an emerging market scenario like Sub-Saharan Africa or Africa in general, we have many companies that started off very tiny. And we've seen them grow. We've seen them merge with others. We've seen them, it was said earlier, beginning to become regional players. And behind all this sits the support of a reinsurance company. So there is indeed that developmental role.
Talk us through, as this balance sheet grows, though, the kind of role and the evolution we see in your role as a reinsurer on the continent, because one would assume there would be less of a need to leverage off a balance sheet like yours, but perhaps more of a need to focus on very specific insurance needs.
Yes. As they grow bigger, they need us less and less, which is not a bad thing. We encourage that. But it also means as they grow bigger, they're able to write or accept bigger and more complex risks. And in that sense, we still continue to work with them. And not to say the small companies don't write big and complex risks, they do, because then they rely even more on us than a bigger company. And here you do mention infrastructure projects. These are multi-billion-dollar projects, a lot of money, mostly, if not all, borrowed. So behind that, there is an interested party in making sure that the project succeeds and the money gets paid back. And our role as insurers and reinsurers is to provide the insurances while the project is being rolled out, whether it's a dam, a hydropower station, or a road. And in the event of a loss, we would make good that loss. So the financiers' interests are secure. The principal, if it's a power station, is the country, their interests are secured. And we do accompany these developments.
Of course, Nicholas, this to an extent speaking to the developmental role that banking or financial institutions play on the continent. It goes beyond just the bank or the financial institution reaping the profits.
Certainly, in any market in which one operates, one's a member of a community. And yes, we have to make our return hurdles. That's non-negotiable. But I think the key part that banks can play in financial services as a whole is how one actually builds the market and allows people to evolve into much more sophisticated environments. So from a banking perspective, I think a key part is working with regulators to create frameworks and actually implement them. That then allows the consumers and the corporates to transact in an environment where they have greater certainty of the outcome, so they know their deposits are secured. If they process transactions, they'll be done completely and on a timely basis. They know the thing won't get lost in cyberspace for 3 days or a week or whatever. But it also allows more sophisticated products to be done, because banks can then aggregate individual savings and start to on-lend that in terms of more sophisticated lending products, insurance products, and that plays across the spectrum. But I think one of the great benefits of global financial services players is they have big systems, they have big capabilities. And it's quite interesting when one goes into countries and talks around regulatory issues, whether it's KYC or sanction screening or global payments capabilities, people are desperate to learn how to do it, because everyone says, thou shalt do the following. Okay, well, that's interesting. How do you do it? And therein, I think, is part of the legacy that global players can actually leave in a country. Now, we've spoken about infrastructure and the importance of that. Infrastructure is vital to any economy. Now, the challenge one has is, yes, we need to spend a lot of money doing that. On the one hand, the country is trying to create national savings, but the reality is, what are the priorities? Do you create pension funds or do you invest in infrastructure? And how do you mobilize all of those savings? How do you get people to go and fund it? And what are the trade-offs? How governments go and make the trade-offs in terms of how one evolves from pretty much everybody keeping money under the mattress to having very sophisticated financial products and probably private equity, hedge funds. That starts to get into the sort of the outer spectrum from a sophistication and complexity perspective. But most national savings schemes and programs are going to be much more between sort of cash, government bonds, municipal bonds, and maybe a bit of equities depending on what the sophistication of the local markets are.
Dave, that leading us to your role then as a private equity player, just how much of a big business has private equity become?
Look, I think in terms of as a percentage of GDP relative to the developed markets, still quite small. Quite frankly, most of our investors in our Global Emerging Markets Fund come from outside of the emerging markets. We would like nothing better than to flip that. We have some key emerging market investors who invest in our fund. But we would love it if national saving systems, pension funds and the like across Africa were investing alongside us.
Why are levels so low?
I think there's a degree of perhaps, is sophistication the right word in terms of the spectrum of what these institutions, have been allowed to invest in or are comfortable investing. There's a private equity job there or role to provide education about what investing in private equity can do for their own returns and diversification. But hopefully it's changing. Certainly the conversations we're having in 2012 with future investor base in Africa and other emerging markets is very different to what we were having, say, 10 years ago when trying to raise private equity funds.
Yeah, when it comes to the returns specifically, I came across an article saying that investments are expected to generate a minimum annual hurdle rate of 30% on funds invested. Are those the kind of returns that are to be had?
It's what we aspire to. It is, quite frankly, it's what the international investment community demand of top quartile private equity funds. And this is where it gets pretty brutal. That the initial conversation with an investor, say, sitting in New York, will say, well, I like the big picture Africa story, but what is your track record of returns? And if you can't demonstrate that you're top quartile in that first conversation, then chances are you're not going to have a second conversation. Yeah. But that's the global demand for capital. But certainly in Africa, we've been able to deliver returns that satisfy those investors.
Yeah. Well, we've just had a question come through from one of the international viewers, and that via the webcast. How will regulators act towards those financial institutions that cannot comply with tighter capital requirements from day one? Who's willing to step in?
Well, I think one can comment from what we've seen. I think BCT touched that on the banking side in Nigeria, for example, where the actual number of licenses plummeted. Same on the insurance side. We had at one time, I've been going to Nigeria for more than 20 years now. At that time, we had up to 150 insurance companies. And the capital requirements were increased. Now we're sitting at around 50. It's still quite a few. But I believe if the regulator continues on that path, you will see more consolidation. And starting an insurance company is not going to be as easy as it used to be.
Sure.
Yeah.
And you see this in more countries.
Sure.
Okay, well, another question that's come through, and this for each of you to tackle individually, pertaining to your respective roles on the continent. The top two most promising investment destinations that you see as a reinsurer, your view, BC, from a consultation perspective, as a financier in Citibank, and private equity perspective as well. Let's perhaps start with you, Junior.
Well, that's a bit of a tough one, but I will answer it in this fashion. If you look at something like infrastructure, which is a big play for us right now, this happens everywhere. It could be a small country building a 50-kilometer railway line, a small country building a hydropower station. At that particular point, that's a very important market. And we've commissioned a few power stations already. So I would say during that period, that small country would be very important to me. And then if you look at it in terms of which economies are doing well, I think it's common cause a number of these countries have been reported on. Nigeria is an obvious choice. It's a big market, big in terms of population, purchasing power. You've got countries like Angola, Ghana, growing very, very rapidly. Interestingly, Ethiopia, with very few natural resources to talk of, but look at the GDP growth, look at what's happening in the economy. I'm just saying, giving a few examples, that's not the whole list.
Absolutely.
Yeah.
BC, in your books?
Well, I think one thing that's key to watch is the enabling framework in determining where to invest.
In fact, one of the countries that stands out in that regard is a country like Rwanda.
Yes, yes. So I think that's key, because the numbers may look good, but do we have the regulatory framework? Do we have the basics in terms of rule of law, the things that are important from an investor's perspective, and what direction are those things taking? And I think those are the things to sort of look at. So if you look at a Nigerian perspective, I mean, one of the areas where there's been major investment, this is historical, has been the oil and gas industry over the years. And I think as we looked at that sector recently, one of the overhang issues we've had is in terms of what really is going to be the regulatory framework for that industry. And we've then seen that people have begun to take a watch and see attitude, because they're saying we need to have certainty around regulation in the oil and gas industry. So I think it's key as we look at Africa, and I'm not sure I would want to look at Africa and look at it from a country perspective. I think you need to go beyond the country, you need to look at sectors within the country, and you need to say to yourselves, what sectors am I beginning to see the basic fundamentals? So basic fundamental, there's a market demand. Basic fundamental because I have certainty over the industry structure, I have certainty over the regulatory framework of that industry. And I think that's what we need to look at. So if you look at Nigeria, for instance, I would say the consumer markets is clear. You know, that's basic supply and demand and getting your business model right. And that's the way it sort of worked. The financial industry in Nigeria, again, tied to the fact that there has been strong regulation, and I think that regulation is beginning to sort of take out the uncertainty, or if I can use the word, de-risk that sector from an investor's perspective. And obviously, there are other, you know, sort of, you talked about Rwanda, you know, countries in Ghana too, for instance, where you look at certain sectors and you can say to yourself, these are sectors that I should invest in. So I won't have a pick like it's a one country or not. I think you need to go beyond that. You need to be a reporter.
Nicholas, is that a shared view?
I think it's a practical view in terms of how one views it. I think sectoral themes are key. If one looks, say, at the DRC, Democratic Republic of Congo, it's not a massive economy, but then they've got an explosion in mining activity in Katanga province based around Kolwezi and Lubumbashi. So that's an interesting opportunity, because but what blows people away is the geographic distance from Kinshasa to Lubumbashi is 1,600 kilometers. That's like Dublin to Munich. You know, there's nothing in between. There's no roads, there's no infrastructure. So you've got to be quite focused in what you're doing. So I think the natural resources is key. Metals and mining, oil and gas are critical areas. Clearly, in terms of looking at it from a corporate and investment banking perspective, scale is important. So bigger economies that are faster growing clearly are attractive, because you have the absolute value of the banking wallet. If you assume X% of GDP is your banking wallet, I think Nigeria is clearly center stage there. An economy of 160 million people, that's about half the size of the population of the USA in a relatively small country, and it's growing and coming off a very low base. So I think that's important. I think in terms of wild cards, Libya, massive foreign exchange reserves, coming off a relatively low base, unclear yet how things are going to play out. but the initial sense and feeling we have is there's actually quite a high degree of structure coming out of there. That could be a very interesting opportunity over the next 5 years or so. East Africa community, still trying to figure out how to manage all the different bits and pieces there. But Ethiopia is another interesting opportunity. Big economy, 80-odd million people, second biggest population in Africa, lots of cattle. If it starts to export and generate foreign exchange, becomes really exciting. So, I think the opportunities vary. I think the sectoral themes are important. Clearly, countries with a lot of natural resources, oil countries are important. And, so one needs to be, there's a variety of opportunities available, depending on one's risk appetite and preferences, I think.
Yeah, it's very difficult to talk, of Africa as a homogeneous entity, let alone hone in on countries and, everything they stand for.
Alicia, my job as a private equity investor for our investors is to find the best investment opportunities across the continent, full stop. Clearly, country-specific factors are going to play in that as we look at any quality business opportunity. But we look through the sector lens. We identify sectors which we think are going to be the future growth areas. We like to think that we've developed expertise and knowledge of those sectors, of the subsectors within there. And again, no surprise, but where have we put the most amount of capital to work in Africa? Financial services and the consumer sector. Clearly, there are going to be other pockets of opportunity, sometimes quite large pockets of opportunity. And whilst the sort of higher growth economies will clearly attract our interest, even in lower growth markets, and arguably South Africa is one of those, where we find very interesting opportunities to invest in. So it's a very difficult, with apologies to the viewer, to pick out specific countries, but sectors is the way we look at the investment landscape.
Well, at this point, we'd like to open up to the floor for questions. So if anyone has a question for any one of our members of the panel.
Okay.
Yes.
My name is Mbi Mbape. I'm the CEO of Unimana Associates International. And I have two quick questions. The first one is that in the discussion, I've actually realized that a particular region in the continent has not been mentioned, which is the CEMAC region. What is the risk that you see? Because as bankers, we first look at the risk before we think of the opportunity. So what is the risk that you see in that region? And what are the opportunities, especially from the two key areas that I've picked up from your conversation, the financial services and the consumer markets? And my second question is that looking at, it doesn't matter what strategy we do in the boardrooms, it ultimately comes down to the consumers. And the unbanked area, market in Africa is actually an area that is almost explosive because it's, we're looking at about just a little below 40% of the continent being banked. What is the generational thinking in the banking environment on the continent right now in approaching that market?
Okay, so let's tackle them.
Not about just the present day, looking beyond our generation. What is the thinking? Because it's about Africa's development, it's about African people, it's about what is the thinking in the banking boardrooms, right?
Okay, so let's tackle those questions individually. First of all, the risk that you see in a region that we haven't touched on right now. Is it a region that you've studied extensively, Dave?
Well, we've certainly got exposure to it through several of our portfolio companies. Look, a tough operating environment, but what constantly amazes me, even after traveling around, is the underlying cash economy that sits in many of these countries. We've got a business that makes fashion fabrics. These products and 4 different brands across can be quite expensive stuff, costing €70 a piece of fabric. And yet the consumer demand that's coming out of these cash economies for quality products is astounding, and the CEMAC region is no different to that. I think one important point there, which we haven't touched on, is the the days of being able to deliver, and it doesn't matter whether it's a financial services product, a consumer product, the days of being able to deliver, or dare I say it, dump poor quality rubbish products on the African economies is gone. The sophistication, and perhaps telecoms has had a role to play in this, increasing globalization mindsets. You have got to get quality right. And if you can do that with the right delivery model to the consumer base, and even in difficult parts of the continent, including some regions of SAMAC, then you're going to make a lot of money.
Nicholas, when it comes to banking the unbanked, I mean, you know, as the formal economy is often shallow and the middle class is small, the thing is that as you venture into banking the unbanked, specifically increasing the scale of the operation can be tricky business.
It is. I think sort of just to talk to the scale of the opportunity, I mean, if one typifies Africa, the sort of the rule of thumb that we use is typically got about 1 billion people, 500 million cell phones, 200 million bank accounts. So there's a high proportion of people who are unbanked. I think the key challenge there is how one actually gets access to them, and maybe there's an opportunity to reverse engineer some of the experiences that our competitors have had in the consumer space, where they've linked up with the telcos and used those little distributors to sign people up on the mobile banking opportunity. That's probably a more effective way of trying to tap into a big market than necessarily having a bricks and mortar banking infrastructure, because that is tremendously expensive to develop greenfield, and maybe it's not appropriate in terms of the way people live and the way people transact. So I think that's part of the agility that happens. I mean, I'd love to get some views from my colleagues here.
Yeah, I was going to pick up on that, and also on the question on the next generation. And what we're finding out, at least from the Nigerian market, is that the next generation is more attuned to what you would call the non-traditional channels and the non-traditional ways of communicating. And if you look at the banks who have been successful in the retail and just capturing the younger generation, it's because they've used things like social media in different ways. And the younger generation are much more agile, much more global in terms of their thinking. And they're the ones who I think are driving the innovation that we're seeing coming out of the financial service industry. So people want to converse. People want to be able to talk to the CEO of a bank. And that's the younger generation. And they want to do that and do it via social media. So we're seeing, you know, at least from where I am in Africa, in Nigeria, is you're seeing that the banks really have to adopt this. And the banks who are getting ahead in terms of the brand equity to the younger generation are the banks that are agile and extremely innovative in adopting this. And I think that really is going to be the key to the next generation. So it's like everything else in Africa. You're almost going to skip a generation in terms of the leapfrog and the adopting the new ways of banking. And, you know, just picking up on Nicholas, the key to growth for any bank now, as you think about it, is that how can I mine the alternate channels? And how can I do that successfully? I think it's going to be key.
I think it's an interesting theme. I think one of the things that I believe is already it is, but that is going to change the financial services on the continent is the mobile phone. Talking to the question of the new generation, they even converse through mobile technology. But a very important development, mobile operators traditionally have operated and offered a distribution channel to other players. What we've seen in this country is one mobile operator who's applied for and got their own insurance license. That sort of changes the game, because now he's not going to let you fish around his 15 million or so clients. He's going to do it for himself. It's only a small step before that same operator becomes a bank. Then the game changes completely. It also coincides at a time when Africa is reputed to be having the fastest growing mobile phone population. So I see a bit of excitement in that space. And it also talks to, there's a lot of cash in Africa. The mobile operators in Nigeria demonstrated this. The money is there. It circulates. But outside the formal financial services, whoever brings that platform to enable the money to circulate in ways we can measure as economists. It's there, we just can't measure it. I think the cell phone, to me, represents that opportunity.
Well, unfortunately, we've run out of time. We're going to have to leave the conversation there, but thank you all for joining us on the panel this afternoon. Of course, Junior Ngulube is Chief Executive Officer at Munich Re Africa. BC Lamikandra is Head of Management Consulting at KPMG Nigeria. Nicholas Young, Chief Operations Officer for Africa at Citibank, and Dave Cook, Director of Actis as well. Thanks to our audience for joining us this afternoon as well. That's where we leave it for this edition of the KPMG Africa Conversation series. From me, Alicia Seckham, it's goodbye.